Welcome to this explainer. Today we're diving into the ultimate business mystery. Why do supposedly profitable businesses suddenly run out of cash? Seriously, it's a paradox that literally kills thousands of small businesses every single year. And you know what? It usually starts with a really dangerous misunderstanding of what's actually driving your profit.
To solve this mystery, let's look at a guy named Alex. So Alex runs this growing 3D printing business, Polycraft, right out of his garage. His absolute best-selling product? A viral articulated dragon. He sells these dragons for $40 a pop, and the raw plastic filament and electricity to actually make one, well, that only costs him $8.
So on paper, things look absolutely incredible. His tax accountant sends him a profit and loss report showing this massive, perfect-looking 80% gross margin. The report confidently tells him, hey, you're making $32 on every single dragon. But at the end of the month, when Alex logs into his bank account to actually pay himself, it's completely empty. The money just isn't there.
Wild, right? Section 1. The paradigm shift. We're looking at gross margin versus contribution margin. To figure out where Alex's cash went, we have to shift our perspective from the traditional tax accountant's view to the CFO's mindset.
Now, what's really interesting about this comparison is how gross margin completely ignores the massive friction required to actually make a sale happen. It only measures potential profit, like a product sitting safely on a warehouse shelf. But contribution margin, which is the CFO view, subtracts every single variable cost. It measures the actual cash left over after you've paid the toll to the market.
Enter the silent killers. These brilliantly illustrate the expenses that just wipe out that potential profit. We're talking about skyrocketing meta ad costs, where global ad spend is way up, relentless UPS rate hikes, fulfillment creep, and the devastating hidden cost of e-commerce returns. These aren't fixed expenses. They scale up with every single order and just slowly, order by order, eat away at your margins.
So let's look at what happens when we apply this CFO filter to Alex's $40 dragon. We subtract his $8 production cost, sure, but then we also subtract $14 in Facebook ads, $8.50 in shipping, and $6 in marketplace fees. Suddenly, his true contribution margin isn't $32. No way, it's a tiny $3.50. Every time he sells a dragon, he's basically just passing money from his customers straight to Mark Zuckerberg and the shipping carriers.
So the absolutely crucial point here is that high-volume products can actually be incredibly dangerous. Alex's viral dragon is what we call a zombie product. I mean, it looks profitable on paper, and it keeps the 3D printers busy, but it might actually have a negative real contribution margin if ad costs spike even a little bit. On the other hand, look at product B, a really boring replacement bracket, found through SEO with low ad spend. That has a massive positive contribution margin. The takeaway? Zombie products will quietly bankrupt you, while boring star products actually drop real cash into your bank account to cover overhead.
Okay, moving on to Section 2, finding your break-even point by applying the CFO filter. Let's dive into exactly how we use this contribution margin to figure out how many items you absolutely must sell just to survive.
Think of this metric as your safety net. After all those variable ingredients, shipping, and ad costs are paid, the contribution margin is the actual, tangible cash left in your hand. Every single sale must contribute a positive amount of this cash to pay down your fixed overhead, things like your garage rent, software subscriptions, and, your own salary, before you can even think about recording a net profit.
Let's ground this with a quick case study of a Hawaii milkshake shack. If we want to find the real margin, we have to strip away all the variable ingredients layer by layer. The whole milk, the premium vanilla ice cream, the specialty flavored straws, the cups, all of it. For a $7 small milkshake, those variable costs subtract out, leaving us a true contribution margin of exactly $4.82 per shake to put toward the shack's rent and employee salaries.
To put that into perspective with another example, let's see how this dictates your break-even point. Say a toy giraffe yields a $4 contribution margin, and your fixed annual overhead is $200,000. Well, the math is absolute. You take the $200,000 divided by 4, and you find that you are forced to sell exactly 50,000 units just to break even. If you sell 49,999, you're losing money.
All right, Section 3, the SaaS margin reality and the hidden costs in the digital world. Now, you might think software companies are totally immune to this, but let's move over to the digital space and see how this builds up.
Even a $150 SaaS subscription has hidden variable costs constantly eating into it. You've got to subtract Stripe payment processing fees, AWS hosting per tenant, third-party data APIs, and even the fractional cost of customer support staff allocated per user. By the time you deduct all of that, your true contribution margin is closer to 70%, not the 100% that so many founders like to imagine.
And this matters immensely when you're calculating your growth metrics. You see, calculating your customer acquisition cost payback period using just top-line revenue is incredibly misleading. It overstates how much cash you actually have. You have to multiply your revenue by the contribution margin percentage to find out exactly how many months it really takes for a new customer to pay back their marketing cost and finally become profitable for your business.
Section 4. Mastering operating leverage. Basically the final boss of profitability. Let's zoom out to the macro level and see how your contribution margin feeds into the ultimate financial structure of your entire company. So this brings us to operating leverage, which is the structural balance of your business. It essentially asks, is your cost base mostly fixed things like rent and salaried engineers, or is it mostly variable things like hourly labor and ad spend? This structural balance determines whether your business scales beautifully as you grow or crashes devastatingly during a downturn. Venture-backed tech companies intentionally build high operating leverage. They have massive fixed costs up front to build the software. But because their contribution margin on each new user is so high, once they finally cross that massive break-even point, almost every new dollar drops straight to the bottom line. It creates that famous hockey stick profit curve. But keep in mind, actually, this is crucial. If revenue drops, those fixed costs do not budge, which can rapidly destroy value. Moving into our final segment, the action plan. How to audit your products today. So how do we actually put all of this into practice so you don't fall victim to the profit paradox? Good news, you do not need a finance degree to fix this. You can audit your products this very afternoon using this 4-step plan directly derived from our source material. First, export your last 30 days of sales data. Second, add columns for those critical silent killers, your average ad spend, shipping, fees. Third, calculate the real contribution margin for every single product in your catalog. And fourth, apply the decision matrix to uncover what is truly making you money.
Once you have your numbers, you just use this simple matrix to immediately identify what's going on. Your green products with a positive margin, those are your stars. Pour your marketing budget into them immediately. Your yellow products with low margin, a bit risky. You need to raise prices, bundle them, or increase cart value to cover shipping. And your red products, those are your zombies. You must stop advertising them or kill them entirely because they are literally bleeding your bank account dry.
Ultimately, what you should take away from this explainer is a total shift in how you view your reports. As the slide says, revenue is vanity, gross margin is comfort, contribution margin is survival. You really don't need to be a CFO, but for sure, you absolutely need to start thinking like one to survive.
And that leads us to our final lingering mystery. What if you do all this math? Your products are truly profitable at the contribution margin level, but your bank account is still empty. Well, if your margins are truly fixed, what hidden timing issues could still destroy your cash flow? That is the danger of the cash conversion cycle, and it just might be the topic of our next deep dive. Keep asking questions.